Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey and Shad, your hosts for this weekend show. On this weekend show, we're going to be going around the horn talking markets and metals with one of our favorite, more generalist traders. And then in the second half of the show, reviewing a new book that came out from a regular guest on our show focused on the gold and silver markets. Another busy, kind of choppy week for markets. Metals continue to do quite well. And look, there still seems to be a lot of opportunities to make money out there. You just need to be in the right sectors with the right momentum. We are kicking off the show with Rick Bensignor, president of Bensignor Investment Strategies. Rick writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. And on the retail and individual side, something that I'm sure a lot of you, our listeners, are more interested in, check out Rick's In the Know Trader website. I'll post a link to that website. Rick has 3 products, one being the 711 Ultra. This is where he constructs a portfolio like a hedge fund would build. So instead of paying those hedge fund fees, you get this for less than $100 a month. And on the shorter term time frames, he has a weekly report called the Tactical Trader Report and a daily report called the Daily Tip Sheet. Rick, I want to start off with a broad comment on the markets. We talk to a lot of people day after day, week over week, and I've gotten such a mixed, narrative from our guests on the breadth of the markets. We hear from some people that breadth was widening out in the last few weeks. But then we've also heard that breadth is actually concentrated. We heard that tech was lagging the markets, but then we also had people this week saying that tech has now become another leader in the markets. Rick, can you make sense of what's happening under the hood of these broad averages for us, please?
Well, thanks for having me, Corey and Chad. What I'll tell you, probably right off the bat, is the people making the comments about which way breadth is going and which is going up and what's going are generally, in my belief, this is people talking their book and trying to find data to support what they're hoping happens. You can look at breadth, depends on which breadth you're talking about. Is it New York Stock Exchange breadth? Is it S&P 500 breadth? You can always play with statistics to make them be what you want. So first off is know the source. One of the things people know from my 40 plus year career on Wall Street as a commodities pit trader, as Morgan Stanley's chief strategist for many years, as someone who consults to some of the top hedge funds of the world now for many years, is I tell you what I think. It doesn't matter about what prior calls I've made, what I'd like to see happen. I'm generally the first guy who's going to tell you, no, maybe that wasn't what I said 2 weeks ago or 2 months ago. It's not playing out. You need to look at this or that. I think when you talk about breadth widening, sure, Mag 7 is not leading the charge higher now. And there's an ETF, MAGS. You can look at collectively how the Mag 7 are doing. And, it's topped out. It's not materially off its highs. But at the same time, it's not what's particularly leading the market higher right now either. So it topped in early December, not far from the December 6th high that hit Spider's 609, which had been, you have me on your show every month. How many months have I talked about, 609 in the S&P as being the upside target for this move? I think last summer I was already telling you that, way before it ever got there. If you include today, between Spider 608 and 610, you now have the 4th high in 2 months at that same level. And we're either going to ultimately break out from this multiple tops at this level. And if we do, we probably surge higher and start a whole new leg up. On the downside, what's been obvious the last few, I'm trying to think the first time. Well, since the August 5th low, which was a major low that bottomed on a large gap down on news out of Japan, every subsequent low has been higher. So for those of you who are technically oriented, you have higher lows and equal highs. That's a classic ascending triangle. We're either going to break to the downside and retest the bottom of the range, or you're going to explode to the upside. And I think it probably happens fairly soon. I was thinking possibly today's employment report could have been the catalyst for which way we really, ultimately go over the next several weeks and possibly months. It didn't materially move the market itself, and even though the S&P is down some, 40 points while we speak, a lot of it has to do with a typical Friday option expiration and the fact that, Amazon's trading down and Max Evans not, rallying today. There's a few things that are putting a little pressure on the market, but it's also only a little past noon Eastern time, which means we've got almost 4 hours to go. And the way things have been going recently, you could be down 40 points in the S&P and close higher on the day. Volatility, even though it's not showing up at the VIX, intraday volatility is very high. We move 20, 30, 40 S&P points like nothing these days. So with spiders at 602.5, you're still in striking distance of, I'm not saying today, but you're in striking distance of, breaking out above the 609, 610 level and starting a whole new leg higher. Or we possibly hold here again and come back down to 575-ish, which was, the January low.
Yeah, Rick, we've seen a lot of that intraday volatility. So who knows how it's going to break, but we are getting near that tipping point that you just outlined. I guess another comment we've heard a lot this week and even last week, Rick, is that things like the equal weighted indexes are starting to perform better. And so the takeaway some people had was that, hey, maybe there's more participation. I know that you look at things through the vantage point of individual equities, but also through ETFs, and you manage which ETFs are outperforming, which ones have relative strength. Underneath the market internals, are you seeing any sectors that are changing up the batting order as far as how you're looking at which ones are getting the best relative strength?
Well, look, you've got the Mag 7 names span 3 ETFs, XLK, XLC, and XLY. So the K is technology, C is communication services, that's Google and Meta, and XLY is Tesla and Amazon. And in all 3, XLK, XLY, XLC, those Mag 7 names that make up the top names of those ETFs generally represent at least 40% of the entire ETF. So you're still talking about these names being the dominant reason any particular ETF outperforms or underperforms is how these Mag 7 names are trading within those ETFs. If I look right now just broadly, equal weighted S&P versus cap weighted S&P, you have a potential double bottom from last July's lows to December's lows, but the bounce has been so minimal, too early to really call it a double bottom. It's, you got two kind of equal levels. If you pull up you create a ratio chart of RSP, which is the ETF that's equal weighted S&P versus spiders. So you're not really truly seeing breadth widening out yet. You can understand why people are saying it's happening, but the reality is when you actually look at the ratios is it's not happening very much.
So, Rick, where is money concentrating? Is money concentrating in a more bullish, aggressive, growth-focused manner? Is money finding safe havens right now, or is this kind of a balanced market?
I think it's somewhat balanced. Over recent months, you are seeing some non-mega cap names certainly get bids. You're also seeing, instead of like Mag 7, think of, I don't know what name you want to call it, but like the next 25 stocks in the S&P, let's just say the top 30 names. You're seeing much more bidding going into some of these. They're still large cap and they're still at the cream of the crop of all 500 names that make up the large cap index, the S&P 500. But you're seeing some more interest in names that aren't, quote, officially the Mag 7 names, but still very large cap names. So it's good to see it broaden out a way that, retail is not only buying the 7 names that make up the Mag 7. And look, you've got Salesforce and Broadcom and let me think what other things that are popping up that I'm thinking of. Look at what Palantir has done. And they're not even on a large part of the cap scale yet. But that's a stock that has doubled in, I don't know 4 months or something. I mean, it's incredible. And I'm honestly bummed out because I had some resting orders to buy it on the pullback in January. Well, when it's trading at its all-time high back then, I put in a bid in the 62 handle, and we got to I think the 63 something was the low of the January sell-off, and now it's $112 stock, something like that. So you are getting a broadening out of names that are outside Mag 7, but it's not necessarily extending way out beyond still the top tier of the large cap. It's just not necessarily in Mag 7 itself. Uber's bounced nicely. S&P 500 name got whacked, got down to, I don't know, 60, or after being maybe an 80 something high, got into the low 60s, and now it's $75 stock. So there is some decent opportunities. Finding them is, challenging. Do you buy the dips or not? So far, buying the dips generally has worked. But take a prior shining star like Regeneron, and that was an $1,100 stock that's trading, $600-$700. Things, if you don't get the right names, it can be very painful. And that's the challenge. That is truly the challenge of playing a market like this. So I can't tell you specifically right now which sector, because honestly, there's so little that you can figure out of which is going to be the next hot sector. Generally, you can. But right now, for the last month, I've been telling clients, we look at a chart, there's an indicator, and it's not part of most charting systems. I know it's on the Bloomberg, which is a professional charting platform. It is, I believe, maybe I think in stock charts, if you're a subscriber to stockcharts.com, it's called the relative rotation graph. And you could put the 11 major S&P economic sectors, energy, financials, consumer discretionary, staples, et cetera, the 11 sectors up, and kind of watch how they rotate in a clockwise fashion of what's going to be leading, what is leading, what's falling from leading, and what's the worst. And it is almost for last month, there's nothing that shows up as being the next outperformer, which is, some of the sectors have to outperform. There are 11 sectors. Some of them have to outperform. And normally we can kind of get a sense of what's going to come next. And in this case, there is no clue on what's going to come next to be, where to put money to put in, whether it's XLF, XLI, XLK, where you want to put your money next to get the next move up. It is very hard to determine. And I think it's why you're seeing the market so choppy and kind of in a trading range that we've been in for a couple of months now.
Well, Rick, since we've talked last, we've had a lot of narratives that have kind of come to an end or at a decision point. At the end of last year, the second, third, and fourth quarters, you heard things about AI stocks, quantum stocks, space stocks. There was a lot of different narratives running. Then it got into electricity and even things like Constellation, the largest utility, was acting like a meme stock. So we had the big DeepSeek situation come up since we've talked last. We saw some pressure in AI stocks in the semiconductor sector. NVIDIA got whacked. We saw it hit energy. We saw it hit uranium and nuclear stocks. Now the dust has settled for the last couple of weeks. Any takeaways from that period of time where we saw the shakeup in tech and energy?
I think it shows you that investors are desperate to be in whatever is deemed to be the next hot thing. And if you came late to the game in quantum names, you got your rear ended handed to you. A $20 stock became $10 overnight, and it still hasn't much recovered. The trader's market right now, when you get into somewhat of a sideways pattern like we've seen, you got to buy low and sell high. And of course, in theory, that's what we've all been taught. Anybody in the market, at some point, somebody in your life told you buy low, sell high. A lot of investors do the exact opposite. They buy something, it ends up being near the high, and they hold, and when they finally sell out, it's the bottom end of the range. and they sell to other people who are willing to take the risk at the bottom of the range to ultimately try to sell it towards the top end of the range. I think that's how you have to think about the markets now, not get married to names. And until we get a clear breakout that we're actually going to go higher here without another pullback, it's dangerous buying strength. And you need a name that really has momentum behind it to work if you're going to buy strength. Because otherwise, what you're really buying is where smart money is selling. And that's the last thing anyone really wants to do. But it's what so much of the public does do when they're paying attention to headlines and what people on TV tell them to do. I mean, look, honestly, most of the people who are the talking heads on these business television stations are talking their own books. And some sound like really smart people and very likable people, but the reality is they're there talking their own book and doing what's best for them. And they realize they have a platform. So when they say something, it goes out to lots of people and they hope other people jump on board. But they are no smarter or dumber than any one of your listeners. They're just they're people who are lucky enough to have a platform to get that information out. And it doesn't mean that they have even once outperformed the market in the last 20 years.
Oh, Rick, it just ties all back into what you're saying initially is just understand people are always talking their book. So understand where that narrative is coming from. Let's filter down to the metals sector because that sector, the precious metals, have been doing quite well. Gold, very strong this year. Even GDX, the gold miners ETF, that's up almost 20% just this year. So a month and a week of trading. What's your outlook for? Let's just start with gold right now.
All right. So I had lightened up gold exposure months ago near 2,700 at long-term upside targets. And it worked in the sense that you got close to, I think, a 10% pullback, where I made my mistake, even like in my own account, was not buying on the buy signals that I had on the bottom to get back in. And part of that is just I'm doing so many things, so often, and sometimes I'm like the shoemaker who doesn't have shoes for himself, but I make sure my clients are good. When I look at the bigger picture now, it would suggest that you'd still want to be a buyer on pullbacks. In this case, I'd say initially almost every $100, there's something on the chart. But if I had to think of where's the right one now, I don't know. I'd say if it pulls back to 2,700 from almost 2,900 where we are now, I'd probably be a buyer again and replace what I had sold out of. I don't have a particular number. I know people on the street were saying gold 3,000 this year, and that's certainly very possible with it at close to 2,900, but that's just a big round number. There's nothing, I don't see anything specifically at 3,000 that makes it anything special per se.
What about the gold equities, Rick? Because they have lagged the move in gold over the last year or two, but have started having a better 2025, doing a little catch up. When you look at an ETF like GDX or GDXJ, any takeaways?
Yeah, so we're long GDX in, I think it's the weekly tactical trader report. And we're back now on the chart itself, and I'm sorry, on a relative chart to, let's say, long GDX, short GLD. That's worked beautifully since essentially January 1st this year. You're up straight from there. But right now, you're kind of very close to where it all broke down from. It was 1, 2, 3, I don't know, at least 3 bottoms from last summer into last fall, all around a ratio of something like, I don't know, call it 0.155, which means like the price of GDX is 15%, 15.5% of the price of GLD. And that's how you read ratio charts is you divide, what you want to be long by what you want to be short. And this has brought it, right now we're right back up against some resistance of where this broke down from. So would I put on long GDX, short GLD right now and here? No, I wouldn't. It's a trade that for a long time people have tried to properly call the big turn because, as you say, for years, gold equities have way underperformed the price of gold itself. And for here and now, I'd say it's not the right time to do it. And I'm not sure where it is in the bigger picture. Let me just see if while we're talking here. I'll just take a quick look at a like medium-term chart. All right, so it does have a double bottom from January of 24 to pretty much December of 25, equal lows on that, and we're moving up, but we haven't broken above the downtrend yet, or the middle of the W of that potential double bottom. Just too early to say. It's something I watch with some frequency because I'd love to be able to perfectly time that, entry into when you could finally buy gold equities relative to bullion itself. And it might have been on that, December low, but for now, you're still dealing with overhead selling and a general downtrend, a multi-year downtrend in that ratio. So we'll see, but I wouldn't put it on right here and now.
Rick, what is this gold trade all about? We hear a lot of people who, again, are kind of talking their book, but they are saying this is kind of like the 70s, or they point back to a couple of times in history where gold went 6, 7, 8x its price. And in all fairness, if we go back 10 years, gold has gone pretty much 3x its price when it bottomed back in 2015 at just over $1,000. What's going on in the gold market and the markets fundamentally that are pushing people into gold?
I think a lot of it comes down to inflation that really has not been dealt with on a more permanent basis. There's just always inflation. And over the last several years, obviously, the U.S. had very high inflation. The Fed's done everything they can to get back to their 2% target, which I think is a probably unrealistic target. I think 2.5% would be much a smarter target for Jay Powell to kind of concentrate on. It's the long-term devaluation also of just buying power, since, I don't know, about 2000 or so. So in roughly 25 years, gold has done just as well as the equity market has. And there's not a lot of periods of time where you can go that, 25 years and say, gee, gold has done as well as buying equities. It really has it's a combination of, supply constraints. Look at the difference between gold and silver. Silver in the low 30s is, let's call it, I don't know, I'm not sure where it is today, but let's just say it's around $32, give or take. It might be $1 more or less, but somewhere around there. So if the all-time high in silver is $50 and it's trading 32, that's 18. So that's 36% beneath its all-time high. It's not like gold. Silver is more industrially demanded. It's that there's so much more of it, and gold has always just been the instrument used as what theoretically backs currencies. But go back to before there were currencies, go back 1,000 years and 2,000 years, gold coins were the, let's call it, currency of choice and what had the most value. You can't chew gold. You can't make bread out of it. It's not like it has utilitarian service that way. So this is one of those, let's call it, instruments that has its value based upon supply, demand, and the perceived value of what it is and what it means. And the fact now that if you want to buy yourself a gold chain, it's ridiculously expensive. And if it's only going higher, like if you don't own one, you're not likely going to own one in life because, the price has just become extraordinarily high for something to wear around your neck. I think it's the long-term devaluation of currencies and, the dollar. And even though the dollar looks strong against other ones, it's the loss of buying power over time that is why gold is worth what it is, why to some degree Bitcoin, which also a very limited supply, ultimately limited supply instrument, has the values they do. And why both of them theoretically can go up over time. Obviously, Bitcoin far more volatile, but if there is some real value to using Bitcoin as an exchange for goods and services at some point in the future, and you have limited and dwindling supply over time, devaluation of the dollar over time because of inflation never seems to go away, it automatically makes these instruments worth more money.
Yeah, solid points, Rick. Gold hasn't changed. It's on the elemental table. It's just a rock. But the reason it went from 35 to 2,900 is because of the devaluation and the purchasing power of the dollar. You brought up Bitcoin, same kind of thing. It's a scarcity factor. There's a limited supply. There's the perceived value people have in it. How are you looking at Bitcoin? It's had one heck of a move at the end of last year. It's rolled over a little bit recently. Any concerns with the recent rollover, or is it setting up for the next blast higher?
Well, I think if the stock market makes its next leg up, then Bitcoin will likely follow. It's traded very much in line with stocks, not day by day, but you've got, what is it, a double top near 109,000, whatever the all-time highs are. I look at the futures markets for Bitcoin, so your all-time high was made a few weeks ago at 110 and change, and the prior high was 109 and change, something like that. So you've got a double top that kind of lines up with the few tops that we've had in the S&P and Spiders at 609. It's in a trading range. It's holding $90,000 on the bottom, and let's call it $108,000 to $110,000 on top. It's kind of smack in the middle of it right now, and it may need one shakeout down to the low 80s, and once it gets there, it's probably a buy again. But in here, this is all, again, range trading that you have to recognize it for what it is. And right now, until this thing breaks out higher, it's in a approximate $20,000 trading range. Again, on a percentage basis, far more volatile than the trading range that we see in the stock market. But it's kind of like right now, a risk on, risk off type asset. And when people think the market's going up there and we're towards the bottom end of the range, they're willing to buy Bitcoin. And as we get, north of $105,000, there's sellers ready and waiting. And the algos play this stuff too now. So they're going to play the range until it doesn't work. And right now it's working. And, most of the algos are cleaning up because a lot of the public's losing money over the last few months trying to trade.
Very interesting comments, Rick. Always enjoyable having you on the show. Again, Rick Bensignor, president of Bensignor Investment Strategies. Click that link in the show notes to visit the In the Know Trader website, or simply search In the Know Trader, and you can find all of Rick's products for the retail and individual investor. Great having you on the show, Rick. Thanks for taking time with us on this weekend show. We'll chat with you next month.
Thanks so much, guys. Appreciate it. Have a good weekend.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And now, as promised, switching our focus a bit more to the precious metals sector, especially gold and silver, as we're chatting with one of our favorite regular guests, Jordan Roy-Byrne. Jordan is the editor of the Daily Gold. It's been actually a few months since we last had Jordan on the show, let alone on the weekend show. But we really wanted to highlight Jordan's new book entitled Gold and Silver, The Greatest Bull Market Has Begun, a once-in-a-lifetime investment opportunity. Jordan takes us through a number of charts, starting with what really drives gold, some of the relationships to the stock market and other sectors, shares a lot of his technical analysis, drivers for the gold price, and gets into the different classifications of stocks, and then wraps up with his predictions. We're going to break down this book more in chunks and have Jordan explain some of the higher level points here. So Jordan, welcome back to the show, and let's just start off with the general overview of this book. Why did you decide to publish and write this book now? Give us an overview of really what you're trying to encompass within the book, please.
Well, thank you, Corey, for having me back. It's great to be back. I think there's several reasons. I think it's good to, in this industry, get everything down and put into a book occasionally. So this is kind of the third version of something I first wrote in 2015. But this is the most serious version, and I think my 40,000 foot view of markets has really crystallized, and I hope it will be, or I intend for it to be, a good tool for people who are investing in the sector and have some experience, for them to understand the big picture, but also new people that are coming into the sector. I expect a lot of generalists will be coming into the sector, and this could be a helpful guide for them. Some parts of the book are probably stronger than others, but I think overall it can be a very good guide for generalists or the layperson to help them understand markets and secular trends, and then also a focus on gold and silver and the stocks and kind of the important factors and drivers that can push this secular bull market along. And I think the timing is also really important. I mean, I was working on this in 2022 and 2023, but things were different as far as the driving forces of gold and the fundamentals. I mean, you had gold making a pretty big divergence from real interest rates. And so I kind of wanted to let that play out. And at the same time, I was talking about the cup and handle pattern quite a bit. And there was still this question of, how much more can precious metals really move as long as the stock market is in a secular bull? And so I think that conundrum, I mean, it's still ongoing today, but as we've seen the breakout from the cup and handle, and the sector is starting to take a step here, this could be a really important inflection point at the beginning of this year, and we'll see if that's proven correct over the coming months. But when you're at secular turning points, I mean, there's only, 3, 4, maybe a handful of those in the last 100 years. So the timing is really good, where we're coming to the end of a secular bull in U.S. stocks, and in a secular bull and gold and silver and hard assets is really just getting going and maybe taking the next step. I mean, there is some overlap historically, and I talk about that in the book, but I think that the timing is really good, because I think if I waited another year or two, it might have been too late. And at the same time, I mean, maybe it would have, the perfect timing probably would have been 6 months ago or so. But, when you're writing a book, you can never time it perfectly.
Well, Jordan, we're just glad the book is out and that we're discussing it. And I do hope it helps a lot of new investors that find the sector. You kind of kick it off with what gold even is. And in a nutshell, it's money. And it's actually an uncurrency. It's like a currency, but it's a way of hedging against all the other risk in other fiat currencies. And you make a point in the first couple of chapters about digging into the correlation it has with bonds, interest rates, and the currencies, especially real inflation-adjusted interest rates. So maybe weave that component in as far as one of the key drivers for the yellow metal.
Yeah, I mean, the major driver for gold is that inverse correlation to real interest rates. So that historically has been the biggest driver, although it's interesting because tying in the bond market is very important. And so, not to get off track with respect to real interest rates, but we're deviating a little bit from that right now. And we also did at certain points in the 70s. So it still is the number one driver of gold. And I mentioned in the book, I mean, PIMCO did a study of this at some point, and so they found that the real 10-year yield, the inverse correlation there, that's actually the strongest fundamental indicator for gold. But there were some points in the 70s where there were just sharp moves in real interest rates in either direction. And, I think we could see the same this time around, given that you have a secular bear market in bonds. And so, not to deviate from real interest rates, but the secular bear market in bonds, people don't realize we've only had one of those in the last 100 years. I mean, until 2020, basically from 1920 to 2020, there was only one secular bear market in bonds. And that was about, 1965 to 82. And so the indicator I use for that is the 80-month moving average for total real return for bonds. That's just the total return adjusted for inflation. And so when that data series lost the 80-month moving average in the mid-60s, that's when bond returns were bad, for lack of a better word, until the early 80s. And so there's only been one of those in the last 100 years. And it's something that nobody talks about. I think few people realize it. And so that changes the correlation with real interest rates a little bit, but that is such a powerful the fact that we're clearly in a new secular bear for bonds. After COVID, it lost that 80-month moving average, and it hasn't even come close to regaining it. So that is such a powerful development, I think, for just all markets, for in secular trends in general. And so the people, they don't really have a playbook for what happens. So I try and write a little bit about that in the book. Also touch on the secular bear, I think from 1900 to 1921, or 1906 to 1921. That was also a secular inflation period, but it's just such a powerful development.
Jordan, there are a number of secondary drivers that you also point to, those being the yield curve, US dollar index, and central bank demand. We can also tie in how gold is done against foreign currencies, so not just the US dollar. Talk to us about how you can balance out these secondary drivers as well in terms of what can drive the gold price.
Yeah, I mean, it's first and foremost, it's real interest rates, as we said, and then we have the bond market as well. But there's other drivers. There's the yield curve when you get a steepening in the yield curve, and the yield curve has steepened, I don't want to say considerably, but more than a little bit over the last quarter or two, and precious metals have continued to perform well. I'm not real keen on the dollar. I mean, that the dollar is a driver, but when you look at gold against foreign currencies, like that tends to be a big leading indicator technically for gold and dollars. So that's an important technical thing I look at. The dollar itself, you tend to see gold lead the dollar, just like it leads real interest rates. You get gold leading both ways at major turning points. So that's why I don't talk about the dollar a whole lot. But what's really interesting is the secular trend in the dollar in the stock market. It tends to be aligned. So if you look at the secular bear in the dollar that we had from 2001 to 2008 or 2001 to 2011, I mean, that was almost perfectly aligned with the secular bear in U.S. stocks. You didn't have a perfect secular bull from 82 to 2000, but most of that period the dollar was going up. I think it was going up from 93 or 94 until 2001. So now we're seeing something really similar where the dollar put in this low in 08 or a slightly higher low in 2011, and it hasn't been pretty, but it's been trending up since that point. So you have a clear secular bull in U.S. stocks and also the dollar. So I don't necessarily agree with, I mean, I guess it can be true in a short-term aspect where the weak dollar is good for the market, but when you take a 40,000-foot view, you have to understand that the secular trend of the dollar and U.S. stocks is aligned. And so I don't see the dollar going into this big bear market without the stock market going into a secular bear. So those two are aligned. And I think that's a important point that people need to understand. You're not going to see a bear market in the dollar and then the stock market, keep running, to higher highs over the coming years. So those are aligned. And yeah, it's really interesting because, this bull market is but it is breaking some fundamental norms where you look at the secular trends in the dollar and even the declines that we've had, the cyclical declines that we've had in the dollar when it's in a secular bull, you don't tend to get really good moves in precious metals when that happens. So that's another point that I made in the book. But on the other hand, you look at what's going on now and, precious metals have performed reasonably well, despite the fact that the dollar's in a secular bull alongside U.S. stocks still being in a secular bull. And so, eventually, to tie it into today a little bit, eventually, when the secular bull ends in U.S. stocks and more money starts coming out of stocks and goes into gold, I mean, gold and precious metals are really going to go vertical.
Well, Jordan, let's dig into that topic a little bit further. This has been a key point you've made a number of years that, in real terms, the bull market in gold and precious metals equities is going to be when you see the corrective move in the general U.S. equities. And they've actually been going up in tandem, which is a little unusual, but that can happen for periods of time. And if you look at something like a Dow gold ratio chart or an S&P gold ratio chart, it's been compressing lower and lower, kind of flatlining because they've been kind of moving in tandem. Break down for people listening why you think the eventual rollover in U.S. equities will be such a seminal moment for the longer-term secular bull in precious metals.
Well, if you think about it, stocks and bonds are the major asset classes that compete with precious metals. And I obviously make this point in the book, but the 1970s, and I think we're really somewhat closely, not somewhat closely, but we're mirroring that period where 65, you had the bonds go into a secular bear, and then you had the stock market itself at the end of 1968. So bonds this time around, I think bonds going into a secular bear are going to lead to the stock market going into a secular bear and the dollar around the same period. It's possible because if you look at the last secular bear in the 2000s, the stock market peaked, I think, over a year before the dollar did. But anyway, so if you think about it, all these big funds and organizations, pension funds, sovereign wealth funds, family offices who they manage millions and millions of dollars. And when you had a secular bull in bonds, they could get really good income from that, 2, 3, 4%. I mean, that's significant income when you're managing $50 million or $100 million or even $20 or $30 million. And so money has come out of bonds. A little bit of it has gone into precious metals, but most of that has gone into the stock market. And again, you look at intermarket analysis and how gold's performing. Gold is outperforming everything. It's doing really well. It's crushing bonds. But U.S. stocks is the last thing that gold basically needs to conquer. But that's aside from bonds, it's really the biggest asset class. And so, again, we look at how gold is performing. It's clear that's the one thing that's holding it back. And you look at a chart of gold against the S&P, and you hear these statistics like, oh, well, gold, let's outperform the stock market in the last 13 months or 2 years. It sounds good, but if you look at a chart, there's no clear uptrend yet with respect to gold against the S&P. Now it is, I think yesterday we closed at 0.48. If we do get an explosive move with respect to gold against the S&P above 0.50, which we're really close to, that would be a major turning point. Because all this money that has been staying in stocks, when some of that starts to move into gold, not only do you have a real bull market, but like I said earlier, you're going to see gold and silver really go vertical at that point because there's nowhere else for that money to go. And so with the secular bear in bonds, again, initially, the majority of that money has moved into stocks, probably bigger companies, these organizations and funds with, $100 million and such, they can get their income now from the dividend aristocrat companies. But when the stock market cracks, some of that money, it's not going to go back into bonds. The only place it can go at that point is gold, and then secondarily silver. And also it's not going to go into crypto. I mean, crypto since 2011 has basically traded with the NASDAQ. So that to me, I mean, just thinking about where we are now in the next few years, like when that happens, that's going to be such a major turning point for precious metals. And by the way, historically, you look at my gold against the 60/40 portfolio chart, and that's actually, right now, it's trying to break out of a 10-year base, like a perfect 10-year base. And so we really need gold to outperform the stock market for that breakout to be confirmed and really have the potential to accelerate. But, historically, you go back and you look, the secular bull markets in gold, 2001 to 2011, 1970 to 1980, even the 1930s, those were driven by gold outperforming the 60/40 significantly and the stock market significantly. And that's because naturally, when gold is in a new secular bull market and one that can last a decade or longer, that is fueled and sustained by money moving out of conventional assets like stocks and going into gold. Like what we've seen happening, I write about in the book, it's very similar to what's gone on in the mid 60s. So it kind of puts in context what has happened today, except in the mid 60s, gold stocks, which were the proxy for gold and silver, they outperformed the stock market, even though the stock market kept rising until the end of 1968. So I don't know. We could be maybe in the next year or two or next 12 months, we could be in a period where precious metals do outperform before we get into the turn for the U.S. stock market. But I think the history in the book explains it pretty well. Probably better than my roundabout answer here.
Well, Jordan, to this point about just how well U.S. stocks have done, it's actually crazy to think about. You combine the U.S. markets to the rest of the markets in the world. The U.S. markets are worth as much as the rest of the world combined. So it really has been this U.S. dominance theme that we've seen. You do have a chapter, a part 2 chapter in this book that talks about de-dollarization. It's not written by you, but is this a big picture theme then? It sure sounds like it is, where the faltering of the domination of the U.S. tied into financial markets, that is what's held gold back?
Well, yeah, all the money going into U.S. stocks, that has held gold back. But the fact that we're starting to see sovereign wealth funds and central banks, I shouldn't say started to see, but in the last 3 or 4 years or so, the fact that they've been buying gold, they're diversifying their reserves, that has really helped, or it helped gold during the handle part of the cup and handle pattern. I mean, without central bank buying, gold probably would have dipped to 1,500. So that's a new driver, and that has helped the market quite a bit. Again, when it was building the handle on the cup and handle pattern. But yeah, I mean, if you think about, that wasn't a big part of the bull market in the 2000s. In the 1970s, you could say that really helped catalyze that secular bull in the late 1960s. And we were spending and running huge deficits, and other countries were turning in their dollars for gold. So that helped spring that secular bull. And, maybe this time around, we could say the same thing, that central bank buying in 2018, up until recently, that helped spring the move off the 2022 low and 2023 low. And looking back, we'll probably say the secular bull started at the end of 2023, and then a couple months later, that cup and handle breakout in gold really began it. So yeah, de-dollarization is definitely a huge factor. I'm not an expert in that. That's why I had Vince Lancy write about it, but I don't think it's the most important factor.
Well, Jordan, in lieu of central banks buying gold and seeing it press the bet even higher and higher, and bringing in buyers in the East as well as the West, they don't buy silver. So let's weave silver into this discussion. Silver has been money throughout history. It was kind of demonetized and has been labeled as more of an industrial metal. So a lot of the narratives around supply, demand, and industry and what's happening in solar voltaics. But you're looking at this very pragmatically with the charts, looking at silver as a precious metal as well as an industrial metal. What's your outlook on silver?
Well, my outlook would be really bullish over the long term. If you look at what drives silver, it's really gold. I mean, there's no evidence that the industrial side of it means anything. And yeah, we hear about it now and in recent years where people are talking about silver, they talk about the industrial side. But if you look at the charts and what's happened in the market, that has like zero impact on the price. Silver is a leverage play on gold. Same thing with the gold stocks. They're leverage plays on gold. And, again, look at it, gold against the stock market, gold against the 60-40 portfolio. When gold is outperforming conventional assets, that's when silver and the gold stocks can really outperform. And so going back a moment, this is another reason why gold outperforming the stock market is important. Because when gold outperforms the stock market, you're going to get more generalist money and just more capital in general moving into the precious metals sector. And when that happens, and again, to see this on the charts, that's gold outperforming the stock market, gold outperforming the 60-40. When that happens, capital goes into gold, and there's so much of it that it spills over into the leverage plays like gold stocks and silver. And so that's the important tie-in there between gold outperforming stocks and conventional assets. But, silver, it does have that incredible base. So I should say it's in position to make a really explosive move when it breaks, I think, 37.38. I mean, there's very, very little resistance from 37.38 up to 50. And, when silver breaks 50, if you look at commodities that made those kind of breaks, and specifically copper and oil, they can make really dramatic moves in a short amount of time. So silver, I mean, I hate to be super bullish as I am in this book over the long term, but when silver makes a clean breakout above $50, I mean, that can go to 100 in a year. That's what the history of those kind of breakouts shows you. So yeah, I think the upside for silver is really incredible. And if I'm right, and you're going to see the secular bull market last another decade or maybe even longer than that, the potential for silver, I mean, the numbers are really shocking. So I would say the potential for silver is just, yeah, it's shocking. And so based on that, I am really bullish. It doesn't mean that you should, buy anything with silver in the name or look for, anything that's tiny and has silver in the name. But yeah, the potential there is really spectacular. Although, gold tends to be more consistent as far as performance, though the moves in silver tend to be shorter and more volatile. And last thing, on the industrial side, I mean, maybe that will help silver during cyclical downturns and larger corrections. Maybe that will give silver more of a floor or a higher floor. But at this point, the industrial stuff sounds exciting. But again, historically, it's had no impact on the price. So it'll be interesting to see if that changes. Maybe it will. My guess would be no. That silver, for the most part, will be driven by speculation in gold and precious metals and gold's performance, because it is a leverage play. That's what it comes down to.
You know what else can be a leverage player? The gold stocks. You break down the mining stocks and the junior stocks. I find it very interesting to see your analysis of what happens during bull markets and then the bear markets that follow each, but also how the ETFs have changed the investment landscape into the precious metal stocks, especially gold stocks. Jordan, what can you share with us in terms of what you're expecting, potential leverage for these gold stocks, but then also just how these ETFs have, in a way, altered the investment landscape there?
Yeah, and I mean, I've seen a few people talk about this, but I don't think it's been mentioned really in our industry that much. And so we had the gold and silver. Well, the first gold ETF came about, I think, November 2004. And so before that point, like, people forget this. So before the mid 2000s, and it took a little while for it to catch on. So before the mid 2000s, if you wanted to buy gold, you couldn't do it with a simple brokerage account. Like, you'd have to call a futures broker, buy a futures contract, go to a coin shop. So then if you're managing a portfolio and you want to get exposure to gold or even silver, how did you do it? Well, you bought the gold stocks, you bought the miners. So miners up until that point, just putting the secular trends aside, I mean, generally in the 80s and 90s, miners traded at much higher valuations. And that was because there was a lot of money that really couldn't buy gold or silver in an easy way. So the fact that that has come about has removed quite a bit of capital that used to buy miners. So that development, I think, is the biggest reason why miners have underperformed. The second biggest reason is we've been in a secular bear since 2011. So naturally, in a secular bear, valuations are going to be lower. So that, to me, is the two big reasons. There's all these other reasons, like, there's morons running these companies and they don't know what they're doing, and there's bad management. Yeah, they all may be true, but the creation of these ETFs and the fact that we've been in a secular bear, I mean, for me, that explains 95% of it. And then my third point, which I'd add on to, is, with respect to gold stocks, the inflation adjusted gold price over the long term is an excellent indicator. And it makes sense because, gold stocks are going to follow their margins. How much cash are the mines generating? And obviously the gold price is a huge factor in that, but there's also costs. And so if you're looking at the gold price divided by inflation, it's a very good proxy for the margins of these miners and, whether they're shrinking or rising. And, you think about when we were building the handle and the cup and handle pattern from the summer of 2020, that peak, until late 2023. I mean, how much inflation did we have during that period? I mean, yes, gold corrected, it consolidated, it was holding around 2,000 for a good portion of that handle. But by the end of 2023, if you look at the inflation adjusted gold price, I mean, I think it was like at one point it was down like 25% off the high. So that really explains that third point. And, cost inflation, rising inflation also impacts the miners. But usually that comes after the inflation hits. It's kind of the beginning when it starts to hit. That's when gold and the miners will perform the best in cyclical terms.
Well, Jordan, when you bring it present today and you see the high margins that these companies have, they're the fattest margins in the history of the gold sector right now. Maybe not on inflation adjusted terms, but just in nominal terms, these are fat margins. And the net present value of a lot of the projects, economic studies come out, PEAs, PFS, and you dive into these companies and you talk a little bit in your book about the net present value of the gold mining sector. It's a pretty wild disconnect right now between where some of these projects are valued on paper and where the stock price and the valuations are trading in the market. What would you say as far as the current setup we see with record high gold prices, really high NPVs on projects, but really low valuations in a lot of companies still?
It's one of the best setups of all time. I mean, it really is. I know it's hyperbole to say that, but it's really not when you look at the various factors. One thing, to tie it back to what we were just talking about, look at the inflation adjusted gold price. I mean, that thing is in a massive 45-year base. I haven't checked it in the last couple of days since the end of the last month, because the CPI updates monthly. But we could just say that's breaking out, or it's on the cusp of breaking out of a 45-year base. So what that tells you, a breakout from that base tells you that you're going to see the gold price rise, significantly in inflation adjusted terms. So that's really, really good for miners. In layman's terms, that means if we see gold in the next 12 months go from 2,900 to 4,000, let's say, you're going to see the majority of that move, the vast majority of it is going to go right to the bottom line. Now, on the other hand, maybe if gold goes, at that point, if it goes from 4,000 to 4,500, maybe that $500, maybe 400 of that will be inflation, or 350 of that will be inflation, and you'll see less leverage. So that's the first thing, is based on the gold, the inflation adjusted price of gold, we're really in an outstanding moment, because, again, it's on the cusp of breaking out of a 45-year base. Secondly, valuations. Now, I have various price to cash flow charts, and I have them going back, not in the 80s, but I did find one that shows price to cash flow of miners in the 70s. And so based on all that, generally the miners have traded at anywhere from 6 times cash flow to 25 times cash flow on the higher side. Or we can say maybe 6x, or we could say, 8, most of the, even if we compress that, most of the time we could say 8x to 18x or something like that. Now, 2-3 months ago, the price to cash flow for miners was at 8 times. So historically, you have this range of 6x to 25x as far as the valuation. And again, a couple of months ago, trading at around 8x. So, the based on that, the miners they could easily just go 50% higher and trade at 12x, which would be in the middle, of their historic valuations. And finally, on top of that, I do have one chart looking at, and it's been floating around Twitter, it gets updated every month. If you look at the amount of money, the amount of capital that is in all miners, or all miner ETFs, divided by just the capital that's in all stock ETFs, that's at a 20-year low, or it's very close to a 20-year low. So that tells you nobody is really invested in this sector. So yeah, it's almost a perfect setup. It's one of the best setups of all time. And another point, if you look at the Huey, the XAU, the GDX, GDXJ, there's a sub-index I talk about. We all know the CDNX, the TSXV, the junior index, although it contains, biotech and tech companies in it. There's a smaller version of that index that it's only gold companies, it's 30 companies. You look at that index, that's really close to breaking out from a 10, 12-year base. You look at, again, the XAU, GDX, GDXJ, those are all really close to breaking out of 4 or 5 year bases. So you look at all these factors, and yeah, it's really one of the best setups ever. And we're in position to, potentially have a spectacular next 12 to 24 months.
let's bring it full circle here, Jordan, to wrap us up. We don't want to give away everything, but you wrap up the book with your predictions for gold, for silver, and you back it all up with a lot of these charts in that chapter and also in the appendix. What can you share with us? What are some of the potential levels we could be seeing here?
Corey, it's pretty nuts. I mean, if you just look at the math and you look at what happened at secular peaks, the secular peak of 1980 and then during the Great Depression, it's pretty out there. I mean, for gold, I would just say, I think based on the math, like 20,000 or 25,000 an ounce is just like, that's a done deal. Like, that's pretty easy. I think 30,000 is not unreasonable. And, if you think about the gold silver ratio, again, there's been 3, 4, 5 times historically when it's gotten as low as, 15x or so, maybe even 13x. And, if gold's going to get to 20, 25,000, that means silver is going to get to 1,000. But, it's even possible we could get to 50,000 gold and, 2,000 silver. Now, this sounds really extreme, but looking at all this, I mean, we're not saying this is going to happen the next 2 or 3 years. Like, these targets really don't mean anything for anybody in their financial prospects for today or even in the next 5 years. This is something I'm looking at 10 years, maybe even 15 years from now, depending on how the secular bull market plays out. I mean, I do think that, there is potential for the rest of this decade, or you get into 2028, 2029, you could see cyclically, maybe gold could get to 7,000, 8,000, and silver gets to, 120, 150, something like that. And at that point, you would probably get a nasty bear market, like the one we had 74 to 75 in 2008. So that's something that people have to understand is after every great run in precious metals, you're going to get a 60% bear market in the stocks, and you'll probably silver as well. So, to get to those kind of targets, you're looking at some incredible moves, but also a nasty bear market along the way, maybe even 2. So, yeah, I mean, those targets are interesting to look at, but the thing that people need to understand is we have an incredible cyclical opportunity here over the next few years. But after that, you're looking at a 60% bear market, most likely. That's the one thing they need to understand. The second thing is, this secular bull market in hard assets, this is going to run another 10 years minimum, maybe even 15 years. When you look at the history, you look at how long it takes for these things to unfold, this is going to be with us a very long time. And, something I've done in the last year or so, I'm trying to buy good companies that are really good values, that based on current metals prices, can perform well. And then so obviously if metals prices go up a lot, they can perform really well. So I'm more focused on that, trying to find the best companies, the best values, a little more than timing the market. Timing the market is fine. When we see things get really overbought, you can sell and trim profits. And, when things get oversold and the things are really good value, that's the time to buy. I would focus a lot more on that than trying to worry about the, price levels or these targets in gold and silver. Targets really don't help you as an investor.
Yeah, very good comment there, Jordan. But man, that a lot of those gold and silver bugs are going to love those price targets, even if they are 10 to 15 years down the road. Either way, all of you, if you want some more information on Jordan's book, you can email us or also visit his website, The Daily Gold, to find out more about his technical service and get access to that book. Jordan, great having you on the show. Nice job getting this book published now. And everybody, thanks for tuning in to this weekend show. We hope you enjoyed our coverage of the markets and of the metals. Be sure to check out our website, kereport.com, and podcast. Just search The KE Report in your podcast player to listen to all our daily editorials, company updates, and the full weekend show. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.